Welcome to Unblocking the Chain. My name is Michael Prendiville and I'm your host today. Let me welcome co-host and all-round good guy, Drew Bradford. Welcome, Drew.
Great to be here, Crits.
Good stuff, mate. And Manners in the background. Always a pleasure to have you here, Manners.
Thank you.
Okay, just moving right along. In the last episode, we discussed the institutional program that Jellyseed was participating in with Franklin Templeton, Standard Chartered and OKX. There were some magnificent insights from Franklin Templeton's Andrew Crawford, who made the comment, "We can no longer rely on the guy who says the check is in the mail." We discussed a collateral mirroring program and the benefits for the investment management firm like Jellyseed. It delivers trust, security and allows us to fully utilise the collateral at our disposal. But today, we move on to another esteemed guest, a great mate of the late Ashley Beauvoir Cooper. He is the Chief Investment Officer, the CEO and Director of Convex Strategies, bringing over 30 years of global experience in risk management and financial markets. He is renowned for his deep expertise in volatility, fixed income and emerging markets, having previously held senior roles at Fortress, Atratus, ABN, Bankers Trust and Bank of America across financial centres like Asia, US and Europe. He holds a finance degree from the University of Utah and an MBA from Berkeley and serves on the Singapore Foreign Exchange Markets Committee. He's an all-round good guy. Ladies and gentlemen, he's also, importantly, an advisor of Jellyseed. Please make welcome the one, the only, Dave Dredge. Dredgy, welcome.
Hello, chaps. Really good to be here, Crits. Drew, Minners, nice to meet you.
Very good,
It's
mate.
great to be in town.
Good to have you.
Weather's a bit dodgy, but other than that, it's good.
It's just not as hot as Singapore. It's not hot and sweaty.
Great to have you here, Dredgy. And so for the listeners out there, if you can give us just a sense of where you've come from early in your career. We need a little bit of history.
Okay.
So give us a sense of where you've come from and how you've got to Convex Strategies.
Well, for Minner's benefit, because Drew probably knows almost all of this, as you mentioned, after graduating from University of Utah, I went off to Berkeley, where it was warmer, to go to grad school and had the great honor, if you will, of studying economics under Professor Janet Yellen. More importantly, financial derivatives under a chap by the name of Mark Rubenstein, the founder of the binomial option model and the original
Cox-Rubenstein. Absolutely.
Portfolio insurance.
Yeah.
Graduated from Berkeley, turned down all the jobs in New York so I could stay in San Francisco and join Bank of America, who was then run out of San Francisco because I didn't want to get further away from home, from Salt Lake City.
Yeah.
And 3 months later, they sent me to Singapore.
It's a little further away.
So my ability to predict or even control the future was laid bare very early on. Thus, my transition into positive convexity and optionality. You better hedge the future instead of trying to guess what it's going to look like.
Yep.
And arrived in Singapore the first Monday of October 1987. Got told by a couple of senior trading guys, how lucky you are, whose butt did you kiss? Easiest place in the world to be a trader, Asia. Own the currencies, ride the yield curves, own the equity markets. Nothing can go wrong.
Like shelling peas.
2 weeks later, October 87 crash, Black Monday in the U.S., Blacker Tuesday in Asia. Australian market down 50% in a day. Yeah. Hang Seng down 50% in a day.
I was on the O'Connell Street Futures Exchange that day as a young graduate at the same time.
Yeah, and every position, literally every position. This was before days of value at risk. This was notional limits and what I now then understood as a hypothetical drawdown limit. Every position in every bank and every trading room got stopped out, whether you were long or short or because the volatility was so enormous. Every position got stopped out, and everybody lost sort of 20 times their loss limit. And my mentors, I didn't hear from much after that. And so it kind of dawned on me that maybe what this big, sophisticated institution thought was risk wasn't what risk actually was. And that literally started me down the path, which eventually, after going and helping set up Bank of America's trading and treasury businesses in all of the local Asian branches, as they deregulated in the late 80s. I was in Indonesia, I was in Korea, I was in Thailand. I went and set up their interest rate derivative books in Japan, the Japanese yen interest rate swaps and swaption books. But then eventually I pitched this idea about the importance of convexity in emerging markets because of the complexity of risk. Assuming stable historical volatility and correlation in an EM market with a pegged currency probably didn't make much sense. And the clever guys at Bankers Trust, a chap by the name of Kelly Doherty, who Drew will know well, when I explained this to him, he said, F me, that's a good idea. And in 1991, in the midst of the largest bank merger in history, Bank of America and Security Pacific, at that point in time, I left Bank of America. I was then in Hong Kong and joined Bankers Trust and started what would become their emerging market trading and sales business on this premise of embedding long convexity in this complex, what was a franchise business, but risk was the criticality in that business. It wasn't like then when I was young and naive, I thought developed markets, you could run what I would have called a brokerage business model where you concentrated on the flow and volume and you took risk separately to the extent you had sufficient capital. But running a franchise business in emerging markets, because of the high complexity and much lower volumes, you needed the risk embedded in the business. So you need to embed this positive convexity. And that kicked off. So again, Chris, you're maybe too young, but Drew will know that in 1991 in Korea, there weren't interest rate swaption markets, or in Indonesia, there weren't FX option markets, or in Taiwan, there weren't equity derivative markets. Yeah. So it entailed us trying to figure out how to create the convexity, which started what has become world renowned now, the structured products business. So you went to pension funds and insurance companies and Japanese banks and wealth management and private banks and said, I will pay you this enhanced yield in this structure that embeds you selling volatility, which I then strip out and uses the convexity.
And the great thing about that is each country had their own various accounting rules / structural rules, which made them all individually have an appetite to do that. Yeah. And all in different ways. Like the zero callables, the Taiwanese still do, right?
Yeah, all day.
All day. There's a whole lot of various idiosyncrasies in each country that actually had them coming in and ready, willing, and able to play.
And now, amazingly, it's global. The biggest growth business for investment banking clients, et cetera, in Europe and the U.S. is structured products. Still hasn't caught up in scale with what comes out of Asia, but it's all everywhere. I mean, the system is set up to take the most valuable risk management tool, positive convexity, away from the clients. It's madness. Yeah. And you see every day, I mean, obviously I talk about and rant about it all the time, JP Morgan out pitching their covered call ETF that's however many 50, 60 billion now. And everyone telling me, well, Dave, you always talk about buying vol, but everyone else tells us that selling vol is the way to make money. I said, do you think JP Morgan's losing money? Do you think Citadel's losing money when they set up your vol selling thing on the Robinhood Act and pay Robinhood to send it to them? Yeah. But on it goes and on it goes. And so now in my retirement from the banking system, after retiring in the Deutsche Bank merger and leaving Drew on his own to babysit Ash and kids, I came back in 2005 and got asked by some unusually foresightful people to build a Bankers Trust style emerging market business on the much, much larger footprint that was ABN AMRO's emerging markets. And then I left that in the midst of the RBS merger and retired. But instead of the first time I retired, I was a bit younger, so I went home and went golfing and fishing. This time, if I golf twice a month, I can barely walk. So it's easier to just pursue my hobby of financial risk and complexity and trying to solve some of the problems. And this is something that this big part of why we're all hooked up. The problems with bad investment practices, bad fiduciary practices, all driven by, and going back to what Drew was talking about, what drove this opportunity of getting investors, because it was always the rules and regulations. It's the lack of accountability and the lack of accounting of actual risk. And you end up doing the wrong thing over and over.
Yeah, and they're unintended consequences of regulation / structure / accounting rules in different countries it's not as though any regulator intended for that to happen. It's a side product, but it's as I'm sure are going to get onto some of the stuff going on with the YFY's legislation here in Australia.
Yeah, and now in my my current hobby, with some of my mates, we have our own investment management business. Some people call it a hedge fund, but it's not like any hedge fund anybody's ever seen before, because we're literally only in the hedging business. So we're still in that food stream of this vol selling dynamic all over the world, and we accumulate and build portfolios of incredibly highly convex, negatively correlating risk mitigating. You can think of it as tail risk, our old Bankers Trust colleague Nassim Taleb's philosophy. And we then do that, and our investors use that for actual risk mitigation as opposed to the traditional faux risk mitigation of assumed stable correlations, and then free up capital that's been tied up far too long in, amongst other things, the biggest faux risk mitigator of all time, the biggest opportunity cost to investing in the modern history, bonds, and go and take more risk. And when I can talk them into it, really go and take more risk. Yeah. Go and do the kinds of things you guys are doing. Yep. Thus, our relationship, my advisory, if you will, because we're always talking to people about the same thing, just opposite sides of the distribution that matters. If you can cut off the bad side, as in my race car analogy, you can put really good brakes on your car. You can go drive faster, right? And that's the solution to the geometric compounding path of wealth creation. Yeah. Yep. The opposite to that solution is targeting the mean of the expectation, which is only the average of the divergences, where every divergence, which happens every day, every year, is deleterious to your compounding path. Yep. You want to make the divergences beneficial to your compounding path.
I always remember the analogy about the football field, right? Yeah. Where 90% of the game is played in the middle of the field, yet at each end is where the goals are scored, right? But it's
all the outcome. Yeah.
All the outcome is in 10% of the game, but it's the outcome.
It's the outcome.
It's the same in markets. If you're plodding along the middle, you're getting a bad outcome. It's how do you perform
when it matters?
When it matters.
When it matters. As Benoit Mandelbrot, it's not frequency, it's magnitude.
Yep.
Right. And yet all of the financial maths that I grew up learning and that are hard coded into the regulatory structure of banks and superannuation funds, as we'll talk about, is saying exactly the opposite. It's saying target the average. It's saying that, and it comes down to, and obviously this is a lot what I talked about all day yesterday, it comes down to both bad explicit regulation and rules, but really bad incentive structures. Because in my race car analogy or my football analogy, the race is 40 laps, 40 years of investing for someone's retirement savings. Yep. Right? And the objective of that should be geometric compounding. It should be separation over time. Yep. But the incentive structures and the math behind how pension fund managers operate behave as though the fiduciary, he acts as though all the cars start over equal after each lap. He resets.
Yep.
And so he's trying to solve for one lap at a time, which says, well, let's just target average lap speed. Yep. And on a historical look back, well, last lap, the average speed that was about this, and you wouldn't have crashed. So what's the highest average speed where I probably wouldn't have crashed? And you say, well, I'll do that for the next lap, which I don't know what that lap's going to look like. Yep. And so you come up with the basic 60-40 balanced portfolio, which is literally just driving slowly. Just take 40% of the capacity out of the engine, constrain the engine, bet that that's going to be roughly the average lap speed that you won't crash at, which means you're always going too slowly during the best opportunities and barely hanging on when a curve shows up that wasn't within 2 standard deviations of the worst one you last saw.
Yeah, previous.
And there's no effort whatsoever for the separation. Yeah. And so this is what we're always fighting against. And fortunately, after 35 years of fighting for this, some of my friends in the sovereign wealth fund world have come to agree and have started being loud proponents of what they term total portfolio approach. Okay. And so I presented on stage yesterday some of the research from the Sovereign Wealth Fund in Singapore, GIC, that shows when working with their friends at JP Morgan Asset Management they took a 60-40 benchmark and said, well, if we replace some of the bonds with hedge fund strategies, other diversifying strategies. So JP Morgan took the whole universe, their chosen universe of hedge funds, and broke them into factors. What does this hedge fund do? So the subsets of everything from long short equities to macro to commodities to market event to RV to credit to managed futures, and said all the subsets of those, how does it behave? Is it a equity substitute, an equity complement, an equity diversifier, or a loss mitigant? And then they reran their 25-year, I think it goes back to 2000, 25-year look back and said if we set a limit of 20% of the total 60-40 for an allocation to this to try to improve the risk return, would any of it go to that and replace any of the existing bonds and equities? Well, it turns out the entire 20% went to loss mitigating strategies.
Wow.
That the only thing that was a benefit was negative correlation, performance during market drawdowns, and reliability of that.
Yep.
And that replaced bonds and reduced risk enough that you could shrink your bonds another 2% down to 18% and have 62% in equities. And you made more money with less risk. Now, we asked him at the time, it's funny, we couldn't help but know, we called in our friends and said, we noticed you didn't have what we might dub explicit loss mitigation, let's say long volatility strategies. They said, oh, well, we just didn't have access to that data. We said, well, here's the index.
I was about to say, you have the data.
Yeah. I said, well, here, we've run it for you. And it turns out, obviously, their subset of loss mitigants were 0.1 negative correlation and made 5% on average in the major market drawdowns and were 60% reliable in those drawdowns. But if you embedded explicit long volatility, it was minus 0.6 correlated.
Yeah, but also what would be the return? So because you know what this is, when you get these structured products going one way, you get vol absolutely crushed. So people end up giving it away. And so you're not going to get a 5% return on that. You're going to get 1,000% return. What are some of the returns you've seen when things have gone pear-shaped on some of those variance swaps?
Well, just in this example we did for them, instead of the average return in drawdowns being 5%, and which was predominantly the trend managed futures, it's 21% on average, and the reliability isn't 60% of the time; it's 100% of the time.
Yeah.
So then, when we re-optimized, now all of the 20% allocation goes to explicit loss mitigation, dwarfs everything else, and it has enough risk offset to replace all of your bonds, and you end up with 80 equities, 20 loss mitigation, which makes a lot more money than
Josie, 40 equities. 40 in digital assets.
Well,
20% in loss mitigation.
Exactly. You see, you guys obviously read my notes, right? Because now that I got even less risk, why don't I dial up the risk taking?
Absolutely.
So why am I putting that extra 20% in MSCI World? Why aren't I putting it in tech, innovation, growth, things that will change the world?
Top stocks in NASDAQ, bit of Bitcoin, some other digital assets that are going to be the future roadmap.
And so this is my discussion yesterday in a room full of Australian pension funds, superannuation funds, and several sovereign wealth funds.
Who have zero in the space, except for AMP.
Yeah, and it's just saying, and again, this is something that I've stressed for a long time, decades. In my mind, a sovereign wealth fund should singularly be about wealth preservation and innovation. Half of their book should be invested in wealth preservation, should be in gold and long volatility, and the other half should be in things that make the world better, that change the world, should be in innovation, should be in blockchain opportunities, fintech. It shouldn't be in old school banks. It should be in something that's going to change the world and solve the productivity problem of what is my now current number one pet peeve, population problems, right?
With demographics. We've got
demographics.
The part of the population problem. We've got lots of people, but we were going to have lots of old people soon.
No, so I this coming out in my next note, you'll see the very last line at the very bottom. I have said, because I've shared more of my current feelings about the population demographic issue, and I've added at the last line that I want everybody from now on, anytime you read, hear, engage in economic analysis about growth and inflation and debt and deficit, add this one last line at the end. And every year going forward, there will be fewer taxpayers. Factor that in.
Oh, look, it's a huge problem. It's a problem here. It's a problem in the States. It's huge in countries in Asia. You're like, what's happening in Japan, Korea, China is going to be. It's hard to fathom now how they're actually going to deal with it. You can only see government expenditure going up.
Correct.
Because governments are finding once you start spending money, you can never take it back. So you're going to have to support. People used to die 2 years after they retired. That was that was your life expectancy. You were dead at 67. You retired at 65. Now you're going to live to 100. All the medical advancements. So you're going to be retired for 40 years, not 2. Government's going to keep writing you pensions, and that means they're going to have to sell a lot of bonds, Dredge, but no one's going to buy the bonds.
Correct. And every year going forward, there's
going to sell more.
There's going to be fewer taxpayers.
Yeah, and they're going to have to sell more bonds.
And so those fewer taxpayers are going to have to pay more taxes. The retirees who got financially repressed and forced to save in bonds that they've debased and driven up cost of living, aka inflation, will need more subsidy to survive in their ever longer life, necessitating more taxes on fewer taxpayers. Those taxpayers will, as such, have less excess savings to buy the more bonds that these guys need to sell to fund this. And I will argue, and have for some time, financial repression and fiscal dominance are not simply what we're facing, it's what got us here. This is what's been going on in the countries you just mentioned for 25 years, right? The government has said we need to financially repress to debase our debt, right? We need to keep interest rates below growth rates, R below G in economic speak. And we've done that more or less since 2000. And yet, debt to GDP.
Way. Yeah, it's not a cowardly way. It was the wrong way. It's an easy way to just solve problems. Just spend a little bit more. Spend a little bit more.
But it's wrong. It was okay to do that after World War II, when that population burst. I describe it as the pig going through the python. That population birth was in the jaws. Now it's coming out the other end.
I hadn't thought of it like that.
And the concept, and you think about this, because you guys read as much market economic analysis over the last 20, 30 years as anybody. How could anybody be writing about economic dynamics over the last 80 years without factoring in where the pig was in the python in their country? It's clearly the number one most important impact in the economy. Where are the bulk of the productive resources in their life cycle? Are they earners and savers? Are they retirers and dissavers? Are they buying bonds? Are they running down bonds? And this is the number one thing, in my opinion, driving all, and the opportunity that you guys are a big part of. Because the solution to this problem, as I linked in my note, that I have long advocated, as written by the G10 special study under the BIS in 1998, is productivity gains.
Oh, yes.
Is productivity gains and avoidance of fiscal debt and deficits, right? An emphasis on private sector savings, because you cannot run up inflation at the debasement of savings of the largest population group that when they retire won't have enough money because there won't be enough taxpayers to subsidize them. Bingo.
I don't know if you've caught up the debate while you've been here in Australia, but the Labor government, Chalmers, has got this productivity roundtable going. Productivity per person in Australia has been going backwards over the last 3-4 years. It's the worst in the OECD, G20, however you want to look at it. It's dreadful. So the starting point is at least there's acknowledgement to the problem, and they're starting to sit around. Whether they get some great answers or not, I don't know. But they're starting to look at it, finally, that we have a massive productivity problem in Australia.
That's what needs fixing. And so back to my point, what should, the one thing, Australia's better than almost anywhere else, right? They're younger. They've had a good immigration policy.
Yep.
And they've had, most particularly, a good private savings policy, right?
Well, there is one, we are statistically quite rich. Our per person wealth is top 5 in the world. And we've got our demographics aren't too bad right now. So That's a bit of a saving grace. And our Gini index isn't too high, so that wealth is actually well dispersed as opposed to all being with Gina Reinhardt.
And the forecast for population is also from, say, 27.5, 28 mil to 45 by a certain time. So
yeah, it's still growing. So it's in a much better position, but it still has the issue that eventually the super system will end its accumulation phase and start its decumulation phase. So it still has a population mass, right? It's just not as bad as everyone else. It's at least 20 years behind.
The pig's in the middle of the python, right?
The pig's still in the python. Japan, Korea, China are in a disaster zone, right?
Yeah. And Italy.
And Italy and Germany and France and UK and this is every single country in the world where the pig is in the python is critical to understanding their economic dynamics, and they're going to solve it. But again, this paper that I linked to from 1998 says all of this. Yeah. And of course, they did the opposite of it. And think about it, where are you going to get productivity? You get productivity from private sector investment.
Yep.
So what should have been highlighted was lending to businesses. But what did happen? Everything was linked to asset speculation and consumption. Well, that doesn't grow productivity. That reduces productivity, to your point. And so all of these mistakes have been made, and now people need to figure out how to address them. And the addressing is not more financial repression, exactly to your point, Drew.
It's interesting you bring around not enough loans to businesses. And this is, again, an idiosyncrasy of laws with unintended consequences. If you go back to Australia 25 years ago and look at the bank's balance sheet, maybe they were 50-50 businesses versus retail. All the banks now, their balance sheet, they lend for mortgages. They do not lend for businesses. Businesses as a percentage of loans, much lower. APRA had a higher risk weighting on that. The superannuation funds who own the banks say, get your return of capital up. Easy way for them to do that, lend to housings, not to businesses. If you look at the loss rates that the banks make in Australia, it's zero. There or thereabouts. They don't make any losses because they're not taking any risk. They're not lending money to business. So you're just squeezing that risk appetite out of the economy.
So private credit's starting to make its move.
Goes into that space. So, but again, there's a Dredge's point. Then people actually don't know the risk they're taking because it's not well understood. It's not well constructed risk.
Yeah. So can I summarise? Because
Please. There we go.
Menas is smiling over there, but I just want to summarise for the punters, and we've got quite a young, listeners out there, and it goes all the way up to the experience. But pretty much what you're saying is more equities, more crypto, more vol. Okay, and with that, more long vol. Okay, so let's talk about that just for a second. So more long vol. How do you find value in the vol that you actually pick up? So, for instance, I'll just give you a sense on what I'm talking about here. We have a fund, a digital infrastructure fund. In December, we were up 43%. Smalls up and down until March, down 36%. Last month up 27%. How do we, protect against that down move in March, for instance? How would we find value? What you do at Convex Strategies, you find value in the curve. Explain to us how you do that.
So, big picture, what I advocate and why I think you guys are so good and so important to people. Right? You think about it. An investor, somebody who wants to grow wealth, what he wants to do is make his return skew positive. He wants to cut off the downtail, breaks, and push more of his capital into the benefit of uptails. And it's the exact opposite of how financial market risk regulation flows through the financial system, right? It says low volatility is safe, so you can lever it. And high volatility is dangerous. You should avoid it. So business loans are dangerous. Avoid it. Apply infinite leverage to super senior tranches of subprime CDOs. Now, it turns out the risk isn't the volatility. The risk is the leverage. So from an investment perspective, what you want is you want to own things that in math speak are thin-tailed, that have high natural volatility, So you get rewarded with the potential of upside for the downside risk you're taking. Exactly what you just said. I don't make up the numbers. Bitcoin's probably had 25% drawdowns in the last 4 years, but it's up 350%.
Yep.
You're getting rewarded for the volatility risk
Feels
you're
like
taking.
more than 6.
Feels like more, right?
Dredgy, I'm only 30 years old. Look at me.
And and on the other side, what you want to avoid or what you want to use for hedging are things that have fat tails. And things that have fat tails are things that have suppressed artificial volatility and attract leverage because of the workings of the financial industry. Well, what's the fattest of all fat tails? Government bonds, right?
Yep.
When they had a 25% drawdown in 2022, you'll never get it back because there's only one tail. It's a left tail and it's fat because those things are deemed riskless in the banking system. So you can lever zero risk-weighted asset. You can lever it infinitely. They're deemed risk mitigating in the investment industry. Bonds reduce the risk of your portfolio, which they do not and did not and have not through all of history until the period of...
I remember it. I can't remember the exact date, but sometime in that period when bonds was sub percent, both Austria and Argentina sold 100-year bonds, right? Anybody that sold those, anybody who bought those is going to be in the hole for another 30 years or 40 years. They would have been absolutely smashed on a government bond.
Yep. And the whole system is because, again, these guys, banks don't market to market. It's in a hold to maturity portfolio. I don't know what it was.
Well, your old shop, Bank of America, I read some numbers there.
138 billion. 138 billion of unrealized loss.
Just billion, not million. $1 billion.
The size of the unrealized losses in the Taiwanese insurance industry, because while some people were outright buying those 100-year bonds, the Taiwanese insurance guys were buying the longest ever, largest ever Mexican dollar bond issue, 50 years, all direct placement into Taiwan insurance companies, 5-year call. Wink, wink, right? Yeah. So it goes on their books as a 5-year bond because they've been allowed to
the zero
account.
Callable. Yeah.
And so they've got, now, of course, rates have gone up. They don't market to market. It's now a 50-year bond, not a 5-year bond. It's on their books as a 5-year bond with across the industry, whatever that, if that Mexican bond issue, we remember this one because it was January 4th, 2020. So at the end of December, January 4th, 2021, at the end of December 2020, U.S. interest rate vol in all aspects was an all-time low. So the yield curve was the all-time low, the at-the-money vol, the skew, the surface, the convexity, the term structure, everything all-time low. And on January 4th, 2021, comes out Mexico, Bloomberg, Mexico issues longest ever, largest ever dollar bond. And you drill in, who are the arrangers? Deutsche Taipei branch, JP Morgan Taipei branch. And you got to drill, 50-year, 5-year call. So it's a strip of Bermudan swaptions that the Taiwan insurance companies have sold to the banks that they're now on the wrong side of, that they don't account for, they don't mark to market. Now they're under pressure and they've announced that they're going to start to comply, and starting now, new callables will be marked to market, but all of the old ones, they're not going to mark those to market yet.
They would blow people up by marking them to market.
And that they're going to do, starting in, I think, 2027, over 15 years straight line, they will recognize the losses as though they're not there. We always pretend like they're not there. And so that's the kind of stuff you want to use to protect, right? You want to own the other side of that bad regulatory, bad practice accounting. Guys who are able to sell that volatility, recognize the enhanced coupon as though they're earning an enhanced yield on a 5-year bond when they're short 45 years worth of options, and not capitalize the potential risk. So they inevitably, the supply of that will be too much because the guy can pay himself bonuses on the enhanced annual yield and doesn't have to use any capital. Right. So you want to buy that and benefit from those fat left tails when they occur. There was quite a good move in interest rate vol, let's say in 2022. Right. And use that to own and carry. 2022 was a pretty tough year, if I remember, for the old Bitcoiner crowd.
Sure was.
But if you had a pretty good hedge,
13,500 went down to from almost
64,
70.
65
but
down to 13.
If on the other side of that, you had pretty efficient hedges in things that had fat tails, because you guys can manage. I said this quite aggressively this morning in a meeting with a pension fund manager. you guys are pretty good at managing the risks that you're measuring and you're involved in. Most pension fund managers around town are pretty good at managing their equity risk or managing their EM risk or managing their corporate credit risk.
Yeah.
What they're not good at is managing the thing that they're left with, which is correlation.
Yeah.
Right? And they don't measure it and they don't
Combination of all
manage
of
it.
them.
Right? And so the thing that people don't pay attention to and assume, because that's the way modern portfolio theory or efficient market hypothesis and regulations tell you to behave, that diversification will mitigate your downside. But of course, every time things go down, it starts to accelerate. The fire starts to spread. It starts burning. This tree burns the tree next to it because of the connectivity of leverage between them. And so that's the risk that you want to protect against as you diversify your investment strategy. So the guy who takes his thin-tailed risk in the numbers you just said is getting the benefit of your up months, but he sized it, so he's fine. And when correlation events come along, in a sense, your risk-taking shouldn't have anything to do with the stupidity of uncapitalized risk in Taiwan insurance companies. But when that starts to spread through the system, you want to have in place something that is an offset, negatively correlating to that creates highly asymmetric tails to protect you. And that way, running through the cycle, you cut off the negative compounds, are able to stay in risk, able to run more risk through time, and can push exactly what Drew, more of your risk taking into innovation, into really, upside tails, upside convexity. And the more of that and the more of this, the better you're going to compound.
Is there a rebalancing aspect?
Can be, right?
So,
Absolutely can.
let's say we get a large down move and we've hedged and we're long on the in the fat end, and so for instance we take the profit from the long volatility, and we reset, so we may have minimal on the long vol side, but we're now left with long equities, long crypto at a much better valuation, and then as it starts to rise again. That's when we put on our long vol. Is that sort of a rebalancing program that you would suggest? Or are you saying we should have it on the whole time? Because it's too hard to tell, too hard to time the market.
In general, you should have it on the whole time. You should just buy insurance when insurance is attractively priced, right? And again, the insurance that we're helping people with is insurance of things that nobody, if I call any of my clients or potential clients and say, this is what we're doing because it's the cheapest, most amazing gift we've ever seen. Without fail, they'll say, well, we're not worried about that.
Exactly. It's like you say, European swaption vol is low. And they say, I'm not worried about European rates.
We're not worried about rates going up in 2021. Right? Well, that's exactly the point. And then, who knows what I bought last month? Who knows what I bought last night? We'll talk about that away from the microphone. Right. And so we just accumulate this stuff and then we manage it through the ups and downs and monetizing. Now, there inevitably will come times, and the last time that I remember was something called 2008, where everything that we would have owned, the guys who sold it to us got forced to come back and buy it back. And so then, the risk is out of the system. And here's your liquidity back.
Thank you, mother, for the rabbits.
Right. And so hopefully the investor who had a really good run for years into 2008, because he's now running more risk in all the good times, stays in the risk he wants through the complexity of 2008, doesn't get, forced out of all of his stuff. And at the end of it, his hedge says, there's no risk anymore. Here's all your liquidity. And you get to reset at all-time lows and everything that everyone else has been forced out of. And then you do it again. And then 2011 comes, and then you do it again. And then, taper tantrum, and then China deval, and then yen zero negative interest rates, and then 2018 Volmageddon, and then,
It's amazing. Volatility always gives you the opportunity to buy it. And there's a reason why it gets an asset class or whatever gets massively depressed, and it's be structural. There's a bunch of reasons, but there's always cheap vol somewhere in the world,
and it's violent, isn't it? Once it's been depressed for such a long time, the explosion is violent.
Well, and I will give away the secret to your listeners of what we do.
Okay, everybody, get ready. Stop the car, turn the radio up.
So again, I'm trying to hedge for the risk of correlation, right?
Yeah.
I'm not trying to guess if it's going to be lightning that starts the forest fire or if it's going to be kids playing with matches. Is it going to be that tree or is it going to be that tree? Nobody knows. Absolutely nobody knows. Now, of course, the financial industry have built a bunch of models looking up in the sky trying to forecast lightning strikes, right?
Yeah.
Because the risk is all the endogenous risk of dry brush and trees. So all I have to do, because the risk isn't that one tree catches fire, the risk is it spreads and burns the whole damn thing down, right? So I just have to go and figure out where the biggest risk is in the forest and buy fire insurance on it.
Yeah.
And this is the secret.
Because as soon as one thing goes, the whole lot goes.
Yeah.
This is the secret. How do I know where the biggest risk is? It's where the insurance is the cheapest,
Yeah.
right? Because that risk is the leverage connectivity.
It is because the leverage squashes the vol.
When was the biggest risk to the system of super senior tranches of subprime CDOs? When they were trading flat to treasuries.
Yeah.
When they were the cheapest thing to short in the whole world. When was the biggest risk of interest rates to the system? When
When
the
there was
vol
zero.
surface was at its all-time low, right? And so I go about what we do, despite what many people think. There's people, I'm sure there's still people in the world that think I foresaw everything coming in Asia in 1997, right? I just happened to be convex.
Yeah.
Right?
Yeah. Yeah.
Right? And so it looks like I'm predicting the future. I'm not. I just have really good brakes. So my car's really good at accelerating and decelerating. I'm riding it up when it's good and I'm cutting it off when it's bad without doing anything. I'm focused on making the car reactive, not on forecasting the path. And by doing that, it makes great compounding because I'm always benefiting in the good and cutting off the bad. And so we just look out there. Now, once I accumulate enough interest rate vol in my book, I might get a pretty good idea that interest rates are going up because I can see where the market is susceptible.
It is amazing how the market can get it. We had a situation in Australia where our central bank, and he's always said, I didn't really say that, but he said rates are not going up for 3 more years.
Yeah,
Right?
no, he did say that.
We were running around trying to sell a long-dated mortgage product. We were trying to get people to fix their rates because rates were really low.
Really cheap.
Everyone said, we don't have to. And we had an aim to get, I can't remember the exact things. We had an aim to get NABs. NAB, we had our business loans for something like 25% hedged. We thought, well, let's run around and try and get the hedging up to 50% because rates are so low at the moment. Over that period, the rate rundown, I think we ended up, the book only being about 14% hedged because everyone said rates aren't going up. So then as soon as they do, boom. It's violent. And vol was just, you don't have to worry. Rates aren't going up. Central bank governor says so. Poor Governor Lowe.
And from our perspective and what we do in that environment, because again, this is what Minners and I were talking about before you less sophisticated guys got here. We were talking about the complexity of sort of third and fourth moment isolating derivatives, right? So what we're really looking for is skew and vol, the volatility of volatility. And so that the positioning, the protection on the interest rate move wasn't me betting on interest rates going up. It was me protecting that if interest rates went up, the volatility of volatility would be higher than zero, where I was able to lock it in at the all-time low. Right? Now, that's good insurance. And then we're always out trying to look for that. And fortunately, again, the market will bring that to us when it's the most attractive to own it.
Yeah.
I don't want to go into the weeds too much and talk about vol swaps and those sort of things. But are there any times where, for instance, you will not take out bond vol and you will actually look to equity vol, something like that, low
all the time.
VIX? Yeah.
Again, I told you we're not going to talk about what I was doing last night.
Okay.
On the thing. No, it's whatever it is. So last month,
We commodity or gold vol.
yeah. So going into March 2020, going into COVID, the single biggest position in the book was gold convexity.
Yeah. Because people were
that's what was the
selling all
cheapest.
those structured, effectively selling puts. It was all those structured.
Accumulator to accumulator structures, right? And eventually they've done enough of that it's compressed it enough that the banks will come to us and sell what we want to buy, variance swaps. The most convex, strikeless, maintains convexity no matter how high it goes. And then sort of in answer to the question that you're getting at, when do I monetize that? Well, just like I buy it when they're keen to sell it, I monetize it when they call back in the third week of March, keen to buy it back.
So you know how we sold that thing?
Yeah.
Our risk
Where's
manager
your offer? Our risk manager wants us to buy it back.
Okay, so I'm leading us down a trail here. I'm not sure whether you know exactly where the end of the path is. However, we've gone from bond vol to equity vol, and now we're getting on to Bitcoin vol, for instance. Okay, there has been a hell of a lot of Bitcoin vol sold through big corporates like Strategy, who are doing convertible notes.
Yep.
Okay, now they're going through a program. They're doing at-the-money convertible notes. They're building a curve, and it has squashed Bitcoin vol. Would there be a time where you would actually look sideways or look to a new asset class and go, okay, this is the time, this is cheap vol for this asset class, knowing that if Bitcoin dropped significantly, there could be a hell of a lot of pain in the system as, all this short vol starts to, eat into people's profits.
Yes, absolutely yes. Now, I've been asked, once a week for 6 years, are you guys doing Bitcoin vol? And I've said no. And they say, why not? And I said, because it's
Too high.
It's not risky, right? Because it's too high. It's thin-tailed.
Yep.
I said, something that's thin-tailed, you should own it. You shouldn't use it as a hedge, right? So, we want to use as hedge things that are risky, which means the vol is suppressed, which it attracts leverage and becomes fat-tailed. But that kind of stuff, a la MicroStrategies and some of your old Deutsche Bank colleagues in Singapore that are trying to do structured product stuff and do good old auto-callable structures on Bitcoin. Of course, they're only doing out to 1 or 2 months now. But so eventually, yes, it will get there. And when it gets there, we will be all over it. We'll be enthusiastic as hell. What you really need, though, for it to get there is you need the regulated financial institutions to get involved.
Yep.
You need people who have access to massive leverage and no skin in the game.
And the products, interestingly enough, at NAB, Rob War, my current business partner, and I were looking to do that exact product type of product because Bitcoin vol was running at 80. And to do effectively the buy a note will give you 50% or you buy Bitcoin if it falls by 25%.
Yeah,
so that kind of structured product looks so good that people would have done it all day. And it involves them selling vol, which would have, to your...
Eventually
you would have compressed it
we'll
down.
Build it up, and then we'll get interest.
No one's doing those yet. Or Caroline. Shout out to Caroline up in...
Caroline, Jimmy, go get them, kids.
Up in Singapore. They're doing that, but that market is still very, very small.
Very small. But we pay attention. We talk to the world. I think you guys know this. Some of our investors in the fund are, bulk of their wealth and businesses are in the Bitcoin, crypto, blockchain universe and use us as an offset to some of the risk they have in their books. So we're connected, but we don't trade it because it's not cheap yet. It's got
a long way before it gets cheap.
So it's
it needs the leverage of the financial industry to come in and crush it through these types of products, and the hedging of it to take place by people who are regulated in their risk taking, not using their own capital in their risk taking. So people who use their own capital tend to be smart about risk taking. People who work for regulated institutions don't. They tend to follow accounting rules.
We're 3 years away minimum.
It'll be a while.
I mean, it dipped below 30 vol. Bitcoin did the other day in the, let's say, 1 month ATS, which is kind of an indication of where it's at.
Yep. So again, back to what I said before, I think you should absolutely use that as explicit risk management of the thing you're explicitly involved in.
Yeah.
That's still far too expensive. There's still not anywhere near enough leverage in it for me to use it as a generic correlation hedge for the world. I can get stuff much, much, much cheaper.
Yep.
Right?
Okay.
So, but again, when you're managing risk of Bitcoin, you absolutely 30 sounds pretty attractive to me if I was trading Bitcoin, right? But if I'm hedging somebody's portfolio, I got to go find something far more efficient than that.
That's trading at 1.
The correlation risks of something that I'm going to carry indefinitely through time without any sort of timing and market view, whatever, needs to have much more asymmetry in it than I can get out of a Bitcoin option at the money at 30.
Yeah.
Right.
Yeah.
I want to buy vol at 0. That's good leverage.
Yeah, that's good. I mean, I would say Bitcoin down. I think we talked about this some time ago, maybe a year or so ago. Bitcoin down to what would be a traditional currency vol of, say, let's say,
10.
15, 10 to 15 type thing, is extreme because you don't have central banks smoothing.
Correct. You don't have vol suppression.
You don't have vol
Right?
suppression.
So it has naturally thin tails.
Exactly. So something like that is where you are getting absolute bargain basement. I can't ever see it going, less than something like that because you don't have, a central figure, compressing it. But strategy's trying to do a good job, and he's clearly a very intelligent person that has come up with a strategy. So
I will know it's. People ask me all the time, well, how do you know it's cheap, Dave? How do you know whatever it is we're buying is cheap? I say, well, because the banks are selling me what I want to buy.
Yeah, they're ringing you.
They're ringing me wanting to sell the thing that at slightly higher vol they wouldn't sell. Yeah. But now their risk methodology has said, oh, now that the distribution's compressed enough, now I can. So when somebody calls me, when name a investment bank, calls me and says, hey, would you guys look at variance swaps on Bitcoin? I'll call you. And I'll say, it's cheap.
Now's the time.
It's cheap now, baby.
We need to build down the big supers, and we need to get a product to them which has the long crypto and the curve, a bit of vol on the from the Convex Strategies.
Yeah, and that's the dream. That's the dream. And as I've been arguing all day yesterday and all day today with guys, people, the system is fantastic. Back to where we were on population and the beautiful protection that the forced savings of the superannuation system provides needs to be properly utilized. I will argue, and I think you guys would agree, it's not because of the excessive regulation and forcing of everybody to do the same thing, which is explicitly the wrong thing. And one of the things that it really curtails is that system's ability to invest in innovation, to invest in thin tails, because it's forcing them to, again, call volatility risk, and you should avoid it, and you should apply leverage to things at the mean of the expected outcome, which is actually the risk.
Yeah.
Right. And so, we need to all, and I know you guys do it all the time. I know Drew is doing it just last week, fight this battle. You need to free up so that not just the industry itself needs to be competitive and innovate, right? You've got one of the greatest savings pools in the entire world, and it's being denied innovation in solving better problems for managing and growing people's wealth. And in line with that, a big chunk of that money should be targeting investment in innovative solutions that will solve the productivity problem, that will solve the population problem, hopefully not just for Australia, but for the whole damn world. Right? And bring that technology here. Bring people here because there's a pool that's looking for innovation solutions, whether it's blockchain and crypto or AI or energy solutions or space solutions or communication. What are these things that are going to change the productive capacity of a world who's going to go through a population change that's never happened?
Yeah.
All right.
Yeah.
And it drives me nuts. I hate to see, particularly sovereign wealth funds, but any sort of national savings system. What is the point of enforcing on it as a sort of standard investment philosophy, levered carry trades? Who is that doing any good for? How is that helping the world? Back to your bank thing. Why did we create, BIS regulatory capital that basically subsidized the bank's balance sheets to own government bonds and mortgages?
Yep.
And basically push them out of business lending.
Yep.
Right? That's the business they should be in. They shouldn't be subsidizing government debt. It's the worst thing, waste of money. And what is every crisis that comes along? The crisis is either mortgage crises because the banks have levered too much mortgages, or government debt crisis because the banks have levered too much government debt. Again, the risk is the leverage. And you start calling things zero risk and say regulated institutions can pay themselves annual bonuses on accrual accounting of things that end up with $138 billion of unrealized losses. But all the bonuses are still in their pockets. It's a shame. It's a real shame.
Dredgy, we're going to have to wind it up soon. However, I've got two last questions.
Fire.
One is, if you could change, you were the Australian government and you could change one thing, what would it be?
Okay. Well, I'll make it very simple. I would immediately repeal your future, your super. Right? This is destroying innovation and destroying wealth accumulation for the savings pool. And that's got to go away and let that system grow, expand, be creative, weed out bad practices in favor of good practices, and provide investment in innovation and growth that currently isn't going to take place. So
I
that's
had
number one.
idea how, until we started chatting about that, how the flow-on effects of that legislation to dictate mediocrity in our super investments.
I mean, so back to where we started, and Future Fund, who's free of that, like GIC, is a vocal proponent of this total portfolio approach. Yeah. Total portfolio approach says the only diversifying strategy of value is explicit, negatively correlating asymmetric protection. YFYS bans that from the entire superannuation system. So the number one thing from the leading light of investment capability, Future Fund in Australia, the key to their leadership is effectively banned from the rest of the superannuation system. I guess it's good if they never want anyone to catch up with them in terms of their return track, because it's a sure thing the way it's structured right now. So that's my one.
That's good. Okay, now assuming that we get a bit of movement on that, what does success look like in 3 years' time for Convex Strategies?
So for us, we measure everything in terms of our investors, right? I always say we're different than every other hedge fund you've ever met. And people say, yeah, everyone says that. What makes you different? And I say, we're not trying to make money. And that usually they say, oh, that is different. Yeah. We're only in the insurance business. We're only in the protection business. So what is success for us is more investors. More investors who compounds and grow better the wealth of the money they're managing, right? We hope we never make money, right? Yep. We hope your house never burns down. If it does, we'll be proud to provide insurance on it, right? But what we hope is your assets, your investments, your innovation grows and grows and grows, and we never have another Japan bubble burst or Asian crisis or GFC or pandemic or whatever it is that causes those losses and impedes this compounding path. But for us to make a difference, we need people to use us. Yep. We need people that come to us and say, hey, help us grow this wealth. So we want to be bigger. We don't want to be more profitable.
Yeah, Dredge, I like it. It's one for the. It's actually a purpose-driven strategy, and it's one for the good guys. Crypto has a lot of it's got a lot of purpose about it. It's about bringing in banking for the debanked. It's about bringing in lower fees, bringing the standard of living up for the average guy.
Correct.
And for instance, Convex Strategies is following in the footsteps,
well, again,
we're following in Convex Strategies' footsteps.
What we want is people to use us so that they can
put more money with GIC,
so that they can stake leading advanced technology like you guys are a big part of. That they can help grow the stablecoin universe in Australia. They can help grow blockchain opportunities and better solutions for payment systems around the world. So they can help grow alternatives to wealth storage beyond debasing bank deposits and government bonds, right? But people will be reluctant to pursue that unless they got some brakes, because going out into the unknown can be a little bit scary. But let's put some good brakes on the car and start searching for that gap in the racetrack that we can fire through.
No brakes on the Mustang, Dredge.
Awesome.
Right, I think that's a good time to call it quits. Dredge, thanks very much for being with us. Absolutely fantastic. Drew, as always, looking magnificent today. And Manners, great to have you again.
Great stuff, guys.
Thanks, boys.
Thanks.